how to improve your business cash flow. Brought to you by Google's Bookkeepers. Please do subscribe, like and share the channel. So, very important concept is cash flow, and there's an excellent book that I highly recommend called Cashflow Quadrant, Rich Dad's Guide to Freedom, and it's by Robert Kiyosaki. And he introduced this ESBI quadrant concept. So, brief overview, what is it? The quadrant is whereby there are four main ways to make money, according to this book. You can be an employee, you can be self-employed, you can be a business owner, or you can be an investor. Now, on this quadrant, on this side is where 90% of people are, and they have 10% of the time and money. And on this side of the quadrant, on the right hand side, is where 10% of the people are, and they have 90% of the time and money. So when you're an E, you're an employee, you have a job. When you're self-employed, an S, then you own a job. So you could be going out to work 9 to 5, employee, or you could be self-employed as a doctor, a consultant, trainer, selling your time for money. Here on the right hand side, if you're a B, you're a business owner. Example, McDonald's, where you own a system and people work for you. That's a business owner. Or you could be here like Warren Buffett, an investor, whereby you have money that works for you. So this is the four main ways in the Cashflow Quadrant book. Very good book, highly recommend, as I say. Now, in the Cashflow Quadrant, taking it a step further to look at cash flow, the way the poor people make their cash flow, and this is poor cash flow, is that they have a job, therefore selling time for money. They are taxed and then receive their salary. They tend to have a lot of liabilities. So liabilities are things that are held on the balance sheet. So they'll have a mortgage, a car loan, credit card debt, school loans, other debts, could be store cards, credit cards, just generally. And then they have a lot of expenses. So they've got taxes and mortgage payments and car payments and credit card payments and school loan payments. They've just got a lot of expenses. And this is poor cash flow, because as soon as the money's coming in, it's feeding or funding the liabilities, and liabilities cause you expenses. One thing about this book, it's accounting made easy, really. Now, the rich cash flow is whereby they have more than one type of income. That's number one. And secondly, they have income that isn't dependent on you on this side of the quadrant as an employee or as self-employed, but more, as a business owner or investor. So they might have rental income, dividend income, interest income, royalty income. All of this income, as a result, is coming from assets. So on their balance sheet, they have assets. Assets bring you income, they feed you. Liabilities cause you expenses, they eat you. So let's have a look how the correlation relates between a balance sheet and a profit and loss. So an example of an asset is real estate, as in property. What does that give you? Rental income. Stocks as an asset. What does that give you? Dividend income. Bonds as an asset. What might that give you? Some sort of interest income. Notes, loans to others, intellectual property, other assets that you can create, whether it's music, art, royalty, it brings you royalty income. So you own the rights, the film rights, the musical rights, whatever the rights are. Intellectual property brings you in royalty income. You can license it, get license income. Liabilities are things like your mortgage, and then you've got a mortgage payment. You've got taxes generally anyway, just because we all have to pay taxes. So some expenses we can't avoid. And you've got things like consumer loans, credit card loans, resulting in credit card interest payments and other payments you have to meet to pay these off. So that's how cash flow works, whether it's in a business or on a personal scale. In a business, your assets include, your clients and what you're selling. That's going to give you sales income. But you're still going to have liabilities that you've got to meet, like the expenses in your business in general. You've got rent, you've got staffing costs and so forth. If you want to improve your situation, really easy. 2 main ways. You increase the income. How do you increase the income? Buy some assets. Assets bring you income. Increase your assets, increase your income. Increase your assets, increase your income. Increase your assets, increase your income. It's a virtuous cycle. That's how you improve the situation. One way. Second way, reduce your expenses. And when you reduce your liabilities, for example, get rid of your credit cards, that will then reduce your expenses, because then you're not paying the interest on the credit card, etc. And then when you've saved yourself some money by reducing your expenses, what do you then do with that? Go and buy more assets, increase your income. Buy more assets, increase your income. This works whether you are an individual or whether you are a business. Always increase your assets, increase your income. Any other questions? Email admin@booglesltd.com. Subscribe, like and share if you've enjoyed the channel.